On the hourly chart, you can see we ran buy side here into a bearish order block. We broke down, bearish order block here, displacement to the downside, swept the sell side here, entered the buy side imbalance, sell side inefficiency, rolled over after institutional order flow entry trail here, which is just a partial entry into this SIBI. We rolled through, went through half of the daily buy side imbalance, sell side inefficiency, which is the consequent encroachment level, that blue line, which is just midpoint between the lower level and the higher level of the daily buy side imbalance, sell side inefficiency. That one singular big green candle on the daily chart, that's the reference points here for it on the hourly chart. So we rolled over the 15,185 and a quarter level, which is here, is the daily buy side imbalance, sell side inefficiency, 25% quadrant. Okay, so in other words, if you take this level here and this level here and divide it in equal parts, 4 equal parts, half is here, so halfway between this level and here is this. So it's the lower quadrant, 25% level of here. That's not quarters theory, by the way. I'm looking at an inefficiency and I'm grading that. So these are all algorithmic signatures that price will respect and adhere to. So it's important to know what they are and how to apply it to your charts and then anticipate these types of responses. The market rallies off of that on Thursday, comes back in and retrades back to the consequent encroachment midpoint, and then sends us back up to the high end of the daily buy side imbalance, sell side efficiency high. All right, so here's the 1 minute candlestick chart for the NASDAQ, and I'm going to teach you something that employs my inversion fair value gap. This little area in here where one single candle pass up to the upside, that's a buy side imbalance, sell side inefficiency. So it's not had any overlapping with any other candles after it formed on the downside. So it's lacking what? Sell side delivery. So it's part of this swing low, part of an expected redelivery between the high of the daily buy side imbalance, sell side inefficiency, which is this level up here, and the low of that same daily buy side imbalance, sell side inefficiency. Okay, so if we are up in the upper portion of that range, because here's the consequent encroachment between this level and this level, and we're seeing the market start to break down like it's doing here, this inversion fair value gap, this is part of what many of you ask, how do you know which fair value gap is going to be an inversion fair value gap? How do you know which fair value gap to use? I'm employing a lot of different things. Time and price. I'm using institutional market structure, not your classic higher high, lower low crap, because that's infancy. It's too myopic. You need to know what you're looking for. In the grand scheme of things, price was already working its way down into and towards this redelivery on the buy side imbalance, sell side efficiency low. That's this price level down here. So if we are looking at this price leg running higher with the expectation that we're going to see it roll over, this becoming a fulcrum point, high to low, projected down, that gives us a reasonable expectation to see it reach into a discount range, which would be half of the range between this high and that low, which makes the daily buy side imbalance, sell side inefficiency. The only thing I'm stating is all of this price run here going down is just simply trying to get down to this level here because it was one singular candle on the daily chart that went up. So the market will efficiently deliver sell side delivery, which is not sell side liquidity. Sell side delivery is just the market goes lower. It books price on the downside. In other words, it's offering price between the range high of the daily buy side imbalance, sell side inefficiency and the low of that daily candle, buy side imbalance, sell side inefficiency. So the only thing I'm stating here is if we were to take that range, which is the daily candle, and I'll explain again what I'm showing you here on the daily chart. But for now, conceptually, just imagine if half of the range from that price level here and that price level here, half of that range is here. Anything at that price level or higher is a premium. If we're bearish, we really want to be selling short up here with the expectation that it's going to aim for something down in the lower half and ultimately perfectly delivered to this lower level, 15,126.5. It need not do that. So what levels are we looking for? Because we're not dealing with zones. Well, what's the lower quadrant? Lower quadrant price level is here. Half of the range on the buy side imbalance, sell side efficiency on the daily chart, which is this high and that low that's in purple, half of it's here. Half of the half point and the low is the lower quadrant point. And then you have the Tuesday, August 29th, 2023, 10 a.m., 1 hour, buy side imbalance, sell side efficiency low. We're in a premium. I'm expected to see this price leg roll over. It already broke below it here. So it rolls through. I'm not interested in selling short there because I know that time is a bigger factor. So when price is running up like this, I'm not trying to chase that. I'm not trying to be an early participant. I want to see price get to 8 o'clock. 8 o'clock is here. So the market trades back down through it again. We're not supply and demand. So every time you see a little rectangle here, I'm looking through all of this to go right back to that specific candle right there and its specific price levels. It trades up to it here. Now, because of time, I'm expecting it to have a better influence over price. Does it send price lower? Yes. One more time it comes back up and hits it again. Does it go through it again? No. It's stopping because it's referring right back to that price point right there. So if this is a fair value gap and I was bullish, I'd be interested in buying it when it was going down into it here. Or if it went down through it and it came back above it, now I treat it as, a reclaimed discount array. I'm looking through these candlesticks to a specific PD array, but I'm applying narrative, which is a very hard thing to teach because it's learned conceptually by experience, seeing over and over and over again. This approach to using an inversion fair value gap, because otherwise it would be bullish here. It's not because we're in a premium. I want to be short. I want to be looking for shorts because I expect that daily chart, that big bullish green candle, is going to be redelivered to the downside. And the first level I'm looking for is the halfway point and the quadrant, the lower 25%, which is here. The way that this inversion fair value gap is being implemented is my model, Ma Deuce. Ma Deuce is a slang or nickname used for the M2 machine gun. Okay, so this is simply an inversion fair value gap. How I use that fair value gap is a model. And if we have a inefficiency, as outlined here, between the daily buy side imbalance, sell side efficiency high and low, we're bearish, we're looking for lower prices. We get this market structure in agreement, and then time of price, we're expecting an 8:30 delivery. We can get in here and use this and get ahead of, get ahead of and enter before the news. It's like an x-ray view, tips your hand, or tips its hand to you and tells you this is what it's likely to do. And then you have the inefficiency here, it trades up into it, and at the delivery of 8:30 news, and then we see it run away on the employment numbers, trading down into the lower 25% quadrant between this low and this high. The lower quarter or quadrant level is here, trades to here, and then trades to the 15,175 level, and then ultimately we see it go higher from there. I'm going to zoom in a little bit. There's that gap. So that inversion fair value gap, within the context of expecting it to trade lower, best case scenario, being that low of the daily buy side imbalance, sell side efficiency for NASDAQ, but needing it not to do that to find profitability, which is first partial would be here at consequent encroachment, and you let it run some more to get down to the lower quadrant. And that level, you want to take a partial, and then if you can get down to another discount array, which was in close proximity, which is only 10 handles away, which was that hourly buy side imbalance, sell side efficiencies low on this date and time on your hourly chart. I want to take you back up again. Just know that this is what I'm showing you here. This range, how I'm employing the inversion fair value gap there, here, for Ma Deuce. Ma Deuce is a model that you can use a inversion fair value gap when you are expecting price to run right back down a inefficiency that was buy side imbalance, sell side inefficiency. This can be reversed when you have a sell side imbalance, buy side inefficiency, and you're expecting price to go higher. The inversion fair value gap here would be something after a low, and it would trade back down to it and then send it higher. So everything here is just completely reversed. I'm quite certain you're probably confused right now, and you just have to study it. But really what I'm saying here is this level here and this level here on the hourly chart is this one singular candle. And what I'm saying is on Thursday, I was anticipating the run down into at least the lower quadrant, the lower 25% between this and this, which are these levels here respectively. This candle's low, this candle's high. So we have one singular pass higher. We expect lower prices to be delivered the same way, just going back down to redeliver over the inefficiency here. It was buy side delivery, but now it needs sell side delivery because it's inefficient in that regard, because there's no other candle between this candle's low and that candle's high. Only one candle went higher, and that range defined by that candle here, this low and that high, needs to have efficient delivery. That can only happen by having price go back down inside this entire range. Lower quadrant, halfway point. If you have a inversion fair value gap and you're bearish and you're expecting a news report and it's tipped its hand to you saying, okay, we are likely to break lower in market structure and lower time frames, we can anticipate this drop. That's occurring in here. Drop. And that's occurring in here. Drop. And zoomed in inside that premium to discount. That's the inversion fair value gap. Ma Deuce, second opportunity to get into it again. It breaks aggressively. Inefficiency once more at 8:30 employment numbers. Runs aggressively. Partial here. Partial. Best case scenario would be if it would deliver to the low of the hourly. But I mentioned real time, I said take your profits, don't be greedy. And then we've seen it go a little bit lower than my objective on that particular day, but never got to the low of the daily buy side and sell side efficiency, being this level here. It never got to that level. We're expecting this level here to this level here be delivered with downside delivery, or sell side delivery, as price was going lower. It's not random. It's not going to some random level. It's going to very specific price levels. And if I'm going to use this inversion fair value gap, I can use it in the context of Ma Deuce. Ma Deuce is simply a model utilizing an inversion fair value gap. So that PD array, it's an advanced version or application of inversion fair value gap, but it takes you right back to the core context of where are you in price, what's it likely to go to next, and are you in a short-term premium or short-term discount? If we're bearish and we're in premium, we can anticipate price reaching down into a discount, but not some random level, very specific levels. And it need not go to the best case scenario, which would be the low.